Samantha Azzarello, we got a jobs number last week that a lot of people say is going to seal the deal for a rate hike in December. So will that end the bull run?
So we agree that the Fed will likely raise in December, but we don't think it's going to end the bull run. Because if you look back historically, what really does end a bull market, because let's remember there has to be a cause, there's four main causes, and it's a recession, a commodity spike, aggressive Fed tightening, or extreme valuations. And when we look at how the Fed's going to raise rates and the path and the pace, we don't think it's going to be aggressive in any way.
I remember not too long ago, Janet Yellen was looking at valuations. She called biotech frothy at one point. So what are you looking at in terms of valuations? Which sectors are over and which sectors are undervalued?
So it's interesting. When you look at the broad market valuation of the S&P 500, we look close to 25-year averages. When you go a little bit under the surface, some things are overvalued and some are under. As of right now, compared to 20-year averages, I would say most sectors are a little bit rich, and an exception to that is energy, which is highly overvalued, and then something like telecom is less valued. That being said, I think investors are going to tolerate expanded valuations and higher multiples. So it's really back to the macro story. So what sectors do we like? We like consumer discretionary, and we really like tech based on where we are in the cycle. And I think I would just add, if you kind of segment the market based on value and growth companies are looking undervalued, they're looking cheap, and value companies are looking more expensive compared to these longer term averages. And I think the case for growth to be made is, going forward, if we think we're in a lower growth environment, which we do, we are going to pay a premium and we're going to pay up to get growth.
And you talked about consumer discretionary stocks. We got a little bit of a worrisome call from Macy's with regard to their earnings and their inventories this week. So can you talk about how the consumer's doing heading into the shopping season? Should we put too much stock in what Macy's said?
So I think to note, the underlying heart of the U.S. economy is obviously the consumer. And the consumer is doing a lot better than they were 7 years ago. So we look at, household balance sheet, liabilities, assets, debt. By all these measures, the consumer is doing better. At the same time, we're seeing a little bit of wage growth. Low inflation is obviously good for the consumer. So the consumer overarching is healthy. When we translate that into the retail space, it's a little bit more of a mixed message, because I think you have to distinguish between the traditional big box retailers with the brick and mortar stores and the Amazons of the world with the tech and the new ways of getting products to consumers. And I think that's where there's going to be a real divergence.
And we've been speaking about through the rest of 2015. What's your outlook for 2016? Because we're at the time of the year when people are going to start rolling out their 2016 targets and their Q1 2016 earnings calls.
So 2016 looks like it's going to be more of the same from a macroeconomic perspective. So let's say 2% growth, 1.5% inflation, right? We think the expansion is going to continue at the slow and steady rate, a continual grind down of the unemployment rate. On the earnings side, we're feeling a lot more optimistic. So obviously this year, due to two big macro factors, the dollar and oil, earnings were an absolute wash. We think in 2016, we're going to kind of pick up where we left off in 2014 from an earnings perspective, and we're expecting about 10% earnings growth year over year.
All right, well, thanks a lot, Samantha.
Thank you.
And thank you for watching The Street.